Here we go, folks. The next recession is coming, if not already on top of us. What do we do? Where do we go? All right, let's get into this and talk about it. I do believe that the next recession is coming, if not already on top of us. And that's not a scare tactic. That's not clickbait or anything like that. That's just simply saying, hey, as traders, we want to be able to see the signs in the marketplace. We don't want to be caught unprepared. And of course, profits do come to those that are prepared. We don't necessarily care as traders what the market does, but we do need to be aware of the signals that are out there so that we can set up our portfolio deltas in an appropriate manner. And one of the things that I think, as I was looking at some of these statistics that I wanted to share with you, is just the knowledge that the government's not going to save us. There are no bailouts for us as individuals. There's bailouts all across the world. Nobody is going to drop ship food to us. We need to save ourselves. And so no one is coming to rescue us. It is time for us individually to step up, process this data, and prepare and understand that crises are opportunities. Every COVID was a trading opportunity. The war in the Ukraine was a trading opportunity. Every time we have crises in the world, from a micro or macroeconomic standpoint, it creates an opportunity for us as traders. So I believe that this recessionary environment that we're entering right now is no different than that, but we do need to be aware of what we're up against so that we can sort of build our portfolio deltas in an appropriate manner. And so one of the things that I think is important as we talk about this is, again, this is not a scare tactic. It's not something to say, oh my gosh, the markets are going to crash or something like that because we're going into a recession. But I do just think it is important to be informed and prepared. There was a very ill-timed, ill-fated ad that Matt Damon did some time ago where he was basically being paid to pump crypto. And he, of course, said the famous line that fortune favors the brave. Well, that's not really true. At least that's not how history has measured that statement working out. Fortune does not favor the brave. Just because you're ready to step into the breach does not necessarily mean that you are doing the right thing. Who it favors is the informed and the prepared. And so the more information you can have as a trader, the better decisions I think that we can make and the better the results hopefully we will get. So wanted to share some of that data with you. And part of that, I think, is an interesting statistic as we're around tax time right now. I'm going through all of my trades from last year. And you know what? It's the exact same thing this year as it seems to be for me every single year. The Pareto Principle, or the 80-20 rule, as it is so often called, applies to every aspect of our life. And it certainly applies to trading. Of the thousands and thousands of trades that I make on a yearly basis, it seems like every year in and year out, 80% of my profits were coming from about 20% of my trades. And so there's a lot of wonderful aspects to being a professional trader, a full-time trader, someone that doesn't hold down a job and can stare at that screen all day long and has a little bit of buying power to be able to throw at some of these trades. But there's also some impediments that come along with that. And it is that you do have a overwhelming desire to trade and put that money to use. I don't have a day job to go to. I'm not taking away from any other efforts. And so if I'm not trading, I feel like I'm not earning. If I'm not earning, I get stressed. I feel like my family's not going to be able to, keep food on the table and all that good stuff. The reality is that probably for most of you out there as traders, this Pareto principle applies as well. Meaning probably 80% of your profits are coming from 20% of your trades. So what does that mean for us as traders as we enter a recessionary environment? Well, number one, we want to focus on very large asymmetric type trades. We have one on right now, for example, on the NASDAQ using the futures, the NQs. where last night we put on a risk of about $175. We've got an overlay trade that we're going to be putting on top of that today to cover probably 150 of that $175 of risk. And if the trade works out, it could be a $700 profit. So in essence, we're risking about $50 to make about $700 of potential return. It doesn't mean that the trade's going to work, of course, but that's the type of trades that we should be looking at in a risk-on environment, asymmetric type trades. We also want to develop our skill sets for successfully trading, and part of that is being able to sit on your hands. We try to illustrate a lot of discipline on CPI days. FOMC days, I think, are one of the tougher ones because the announcement comes out later in the day. And it's tough for us in our live trading room to just sit around and do nothing all day long as we watch the market ebb and flow. But we almost always get a good hit. We get a good opportunity on FOMC days by sitting on our hands. And so I think that there may be a lot of sitting on our hands here as we go forward, just looking for, cherry picking those very best opportunities. And then again, I think it's important to look at being effective versus efficient. I love the story of a licensed pilot who also happens to be the world champion at knitting. And he is sitting in first class on an airplane, and they're flying, and he's doing his thing, he's knitting, and there's no one more efficient in the world at knitting than this guy. He's the world champion knitter, for heaven's sake. But all of a sudden, the pilot of the plane has a heart attack, and the plane starts to nosedive, and this guy still continues to sit there and do his knitting. What he's doing is it's very efficient. He is the most efficient and proficient knitter there is in the world, but it's not very effective. He should probably set that down, stand up, go into the cockpit, and fly the plane, right? So we want to be effective in what we're doing. And I think a lot of that is sitting back, sitting on your hands during this time frame, and letting the trades come to you. Let the trades come to you. Don't go out and force it because you have buying power and I've got to put that to work. Now let the trades come to you. And I think you'll have a more successful result. Okay, so why do I think that this recession is coming or already here? Well, Bank of America, specifically Bank of America's Global Investment Strategy Department, has, I think, done an amazing job of putting about 12 data points together on why we are headed to a recession, if not already in one. And I wanted to just collate their very well done data, put it together in a PowerPoint for you here so you have access to it in a video format, because I think they've done an absolutely fabulous job. And the first one that we're looking at here is a decline in manufacturing activity. So this is the ISM index, and March ISM was about 46.3, which is the lowest it's been since May of 2020. In the past 70 years, whenever manufacturing ISM has dropped below 45, recessions have occurred on 11 out of the 12 opportunities or occasions that's happened. So I don't want to say that ISM is a 100% solid predictor of recessionary periods, but it's pretty darn close, pretty darn accurate with regards to that. Okay, so ISM flashing recessionary signals. The next one is a decline in manufacturing. Also, it coincides with lower earnings in the stock market. And, that's a big part of what we're seeing right now. New order components of manufacturing in the ISM are at 44.3, as we said. Anytime new orders are below 45, they have coincided with earnings per share, with EPS recessions. We had one in 1991, we had one in 2001, we had one in 2008, and we had one in 2020. Okay, so again, as we're seeing the ISM negative numbers coming in, we're seeing affecting growth. Fourth quarter last year, our earnings were down. We just are working through the first quarter of this year. Earnings are down once again. So the track that we're on here is not looking good. Number three is global earnings. And how this global earnings model suggests that we're going to be into an imminent decline. Okay, Bank of America's global earnings per share growth model currently predicts earnings per share is going to fall about 16% year over year by August of this year. Now that model is driven by Asian exports, global PMIs, China's financial conditions, and the U.S. yield curve. But all of those things are combining for a global causality in terms of what we're looking at. This is not simply something that is isolated to the United States. And I think that's a critical thing to understand. The next one is basically talking about the steeper yield curve. The steepening yield curve often precedes recessionary periods. And that's exactly what we're looking at right now as a steeper yield curve. The U.S. Treasury 2-year, 10-year yield curve flattens and inverts in anticipation of recession. So, yield curves steepen immediately as recessions begin. U.S. Treasury 2-year, 10-year yield curve is steepened from about a negative 110 basis points to negative 50 basis points in just the past 4 weeks. That's a big flashing signal that we're moving towards a recessionary period. Okay. In addition to that, we have the price of oil showing some concerns of a recession. Supply cuts are not really boosting oil like it would have in the past. Oil prices historically rise into recessions and decline during recessions. And the latest OPEC output cuts, they kind of underscore these recessionary concerns. And we're limited by upward pricing pressure from China reopening so far and what's happening in the global macroeconomic principle of the war situation that we're dealing with. So all of these things are flashing more and more recessionary signals. We move to the next chart. This is the job market. The job market often follows manufacturing activity. This is the ISM manufacturing PMI versus the U.S. non-farm payrolls. And we've had weak ISM manufacturing and PMI numbers, and they suggest that the U.S. labor market is going to weaken over the next few months. That's what the signal is flashing. And adding to the fact that the last February and March jobs report was basically, this is what Bank of America is saying, the last strong payrolls reports of 2023. So we'll see how that plays out. But again, the job market does usually lag and follow the manufacturing activity. And of course, manufacturing activity not looking very strong right now. In addition to that, we've got some other things that are, I think, from a global standpoint, affecting this ability to maybe foresee this recession coming on, and that is global home prices are falling all across the board. Global home prices turning negative at a higher rate in real estate in the U.S., in the U.K., in Canada, Sweden, Australia, New Zealand than we have seen in a very long time. Single-family residential housing, primarily in the United States, but also in other regions of the world, is the number one economic driver that we have in terms of keeping our economy afloat. That's how big of a percentage it is with relationship to all of these economic indicators. So housing doesn't look very good. In addition to that, you guys know that the percentage of 90-day delinquent balances by loan type is headed up. It's not headed down, it's headed up. And that's not good for a recessionary viewpoint either. Okay. In addition to this, we have a decline in European bank lending. Now, we have a global issue with banking right now, but it is very heavily being sort of crimped, if you will, in Europe, primarily in Europe. Bank lending in the Eurozone is down 3 months in a row now. 3 months in a row. Very rare to ever see that in Europe. Outside of the great financial crisis of 2008, the Euro debt crisis, or COVID. Those are the only three times that I can think of in recent history that this has happened. The Eurozone is a $14 trillion economy that is highly dependent on bank credit, and it's not looking very good right now. In addition to the banking situation in Europe, weak job markets generally lead to big interest rate cuts. So as you have falling U.S. job openings, as you have a weaker, that's going to lead into a weaker labor market. A weaker labor market is going to lead into lower Fed funds rate. The yield curve is going to likely steepen very dramatically then into the next 6 to 12 months as the Fed cuts rates ahead of an election. But the long and sort of downside inhibited by inflation and financial shenanigans that's going on is going to create a big problem for the Fed here going forward. This is a huge issue that has yet to really unfold. Another thing that I think is important is to look at what stocks have done after the last Fed rate hike into inflationary periods, right? We say sell the last rate. That there's a saying on Wall Street that says sell the last rate hike, just like in the 70s and the 80s. And you can see right here that it's not been a good sign as the Fed hikes rates into an inflationary environment. And the quote from Bank of America here, I'll just read this. It says, "Our view, sell the last rate hike. Investors are too optimistic on rate cuts and not pessimistic enough on recession. Sell the last rate hike was the correct strategy for stocks in the inflationary 70s and in the 80s. Buy the last rate hike did work out in the 90s disinflationary market." So again, some mixed signals there, but generally speaking, you do want to sell the last rate hike going into an inflationary environment. We're certainly in an inflationary environment right now. In addition to that, probably not a surprise that stocks and recessions don't really mix that well. Recessions just reliably create a negative environment for equities. They've done that throughout history. And I don't think, and apparently the analyses from Bank of America also says this, that we have sufficiently discounted all of this information in advance. In other words, I do believe that there's probably plenty of room for downside in the S&P 500. So again, Bank of America has done a great job, I think, of putting a lot of this data together. We have a live trading scenario that you can participate in that I think is a big help in times like this. This idea that you can go someplace and associate with 200 or 300 other like-minded individuals and talk and banter back and forth and focus on the exact same strategies and the exact same trade setups and work together as a team. I think it is so incredibly important. And we have three ways that you can do that with this. Number one is scalping. So every Tuesday and Thursday, we are in a live Zoom feed where we scalp the E-mini futures contracts. Our goal is to make $500 to $1,000 a day. I will tell you that some days we hit it, some days we don't, but almost every single day that opportunity is there. And we have had a very nice string of success lately in our scalping room. And I think for most people, if you can take 30, 40 minutes a day, do it twice a week, bring in at least $500 a day or per occasion on that, it could be a beneficial thing to look at. Scalping is sort of the top level of what traders do. It's not the easiest thing to do, but it's something that if you're serious about trading, I would definitely put on your agenda. And you can come scalp with us. Just go to the website, tryscalpingnow.com, and come join us in our live scalping feed. We have an award-winning, I'm going to say award-winning, I'm going to get somebody to give me an award. I don't know who, but somebody's got to give us an award here. We have an award-winning asset allocation investment model. It's not trading, it's investing, it's passive in nature, has two primary purposes. One is beat the S&P 500 on a year in, year out basis. And number two, do it at less risk, less volatility. And we have been not only successful with that in the 3 years that this program has been available, but we have absolutely blown the doors off of the stock market. In most years, doubling the market's return, if not more, while bringing in close to 40 to 70% less risk, less volatility. No different for us this year. We are about double the market's return. Absolutely thrilled with that. If you're more of an investor than a trader, if you don't have a lot of time, if you want to look at an investment allocation model that focuses on just taking 5 minutes a day to put your effort into, and then you walk away, you're done for the day, you might want to try our asymmetric trade management approach. And you can do that by going to tryastforfree.com. You can get enrolled in our asset allocation model. You can do that for 2 weeks for free just to see how our portfolio performs. It has been fantastic. It is absolutely, the results speak for themselves, I think. So if you're more of an investor, check that out. If you want to be a part of our live trading room, you can go to try0dteforfree.com. You can come live trade with us. We just booked, as I'm putting this video together right now, it is Monday morning, April the 17th. It's 4:23 in the morning. My time, Mountain Time. We've already booked our first profit for the day. We've already put $100 in our pocket, as we tend to do pretty consistently every day, day after day, with our Theta Ferry trade. That'll start us off into the day to some more zero DTE trades. We've got over 15 different strategies that we're employing every day in an overall model portfolio. It is, I believe, the most diverse trading room that you will find. We love it so much. I find so much value in it that I give you a 200% or a double your money back guarantee. Come trade with us for free for 7 days. If you like it and you enroll in it and you go through our 4 hours of training and you go through the personal hand holding that I'll give you, and you go through our one-on-one Zoom strategy session, and you follow the updating that we ask you to do, and you do not feel like this is the most amazing value, most amazing trading room online today, I'll give you double your money back. That's how strongly we feel about it. We've never had anybody take us up on that offer, because the value is pretty apparent once you get in there and you start getting involved. So however you want to get involved with us, we would love to see you in our trading rooms. I hope this information was helpful for you. Let me know in the comments below. Hopefully you guys are preparing for a downturn potentially in the marketplace here. I know we are in the trading room. Take care, folks. Have a good trading day.